All right, welcome to the show. Be the boss of your money. Man, oh man, this is late for me to be doing the live stream, but 6:30 in New York, a little cold outside where I am, Long Island. Pleasant, wonderful Melville, Long Island. I think all of Long Island is pleasant and wonderful. Let's talk about a couple of quick things because, like I've been saying every day, there's not a whole heck of a lot going on. The market's in a can't say it's a holding pattern, it's a generally up pattern. Today was a quiet day, and it did have a feel like investors are getting a little tired, like maybe the bulls short term have exhausted themselves, but futures are up. And think of it this way: the S&P 500, the benchmark of benchmarks, only has to go up another 5%, and we're at new all-time highs. It's pretty significant for a time when people are not feeling good about the economy, yet jobs are doing well. Job growth is strong. GDP was revised higher, up over 5% for the third quarter. And it's looking like a pretty good year. It's really tough to argue recession right now, although I know we can't predict the future. And the rate hikes so far in the last year and a half from the Federal Reserve may have yet to take hold in a greater way and slowing down the economy. We're going to talk about that. We're going to talk about the numbers of the day. And we're going to talk about Salesforce.com because that stock is up about 9%. And it has just finally surged back into being a premier must-own tech stock. Stock's up $20 in aftermarket trading. So we'll roll the intro. We'll be off in a minute. Stick around. If you could, give us a thumbs up. And, if you have any questions, definitely hit me up in the comments or just say hello. Words of wisdom, words of encouragement are always appreciated. Here we go. All right, we're back. Yeah, that's what happens when you look at your phone and you get distracted. Okay, so we're going to just end this real quick by going through the numbers, okay? Let me just make my screen a little bigger so you can see exactly what I'm looking at, and then I'll just move everything right over here. And all right, we're in. All right, so Dow was up a measly 13 points. NASDAQ was down a measly 23 points. S&P was off 4 points. Gold off $1. Oil, which had been up earlier, was down a little bit. This is the big news, I think, that's not getting enough attention. The 10-year Treasury. I mean, we were talking about 5% a month ago. 4.8, 4.7, 4.5, 4.3. We're at 4.26 now. I mean, we're at 4.26 now. That is low enough to start talking about a 3 handle on the 10-year Treasury. And it does surprise me that mortgage rates, which are still over 7%, haven't come down more. But I would expect mortgage rates to start dipping back into the mid to low sixes in pretty short order because I'm following the 10-year Treasury and I know how mortgage rates track the 10-year Treasury. So stay tuned. And the VIX is below 13. This is pretty low. And it just goes to show you that there's not a lot of fear in the market. Contrarian wise, you'd like to see that up a little bit more, but equanimity wise, it's a pretty good sign for the market. Let's take a look. Oh, by the way, you see the headline here. Dow futures rise as benchmark nears 2023 high. It's not only close to hitting a year high, but we're not far from an all-time high in the S&P 500. Or did I tell you you can't invest directly into an index, but you could invest into a security that tracks or mimics an index? Okay. Treasuries for the most part are down almost across the board. The 2-year is well below 5%. Remember what I've been saying? If you see the 2-year above 5%, stocks go down. Below 5%, stocks go up. And that's exactly what is happening. And the 10-year, the 20-year, and the 30-year all under 5%. You don't get to 5% now until you get to the 1-year T-bill, but you could still get over 5% in a 1-year T-bill. The going betting is this: economy slows down enough, inflation comes down enough for the Fed to start cutting rates a little bit. I don't think the Fed cuts rates just because inflation and the economy slow a little bit. I think you'd really have to see the economy really start to slow. I think the Fed would prefer to see if where they are now is the neutral rate, meaning where interest rates are not too strong, not too weak. They're just right, just Goldilocks, not too hot, not too cold, just right. So that they don't have to, so that the Fed doesn't have to make any changes. We'll see how it goes. There are those out there who say the economy is going to slow down a lot next year. The Fed's going to be behind the 8 ball, and they're going to have to cut rates aggressively. And there is those that say, no, inflation is still going to be persistent. The economy is not going to slow down that much, and the Fed's not going to do anything. They might even raise rates. The predictions are all over the board, and here's the takeaway from this, okay? Right now, you are seeing a parade of big Wall Street firm strategists coming out with their predictions for 2024 on how the market's going to do, the stock market and the economy. Some are saying really good economy, really good stock market. Some are saying weak economy, strong stock market, strong economy, weak stock market. The predictions are all over the board. I want you to think of these predictions in this way. Don't let them scare you, but don't let them get you bulled up either. Because whatever the prediction is for next year, are you going to make any changes based to anything? Are you going to change your financial plan, your investment plan, because of stock market predictions for the next 12 months, which are mostly wrong? I mean, there's always somebody that gets it right, because if you have enough people guessing what the stock market and the economy are going to do next year, odds are you're going to get somebody who's right. And everybody who puts out a prediction says the market could go down, it might go up, but the Fed might do that. So nobody's giving you a real prediction. They're kind of saying, well, I think there's an 80% chance that the market's higher next year. So if the market goes down, they'll say, well, I did leave room for the market going down, a 20% chance, so I'm covered. These, to me, aren't real predictions. These are just fantasies. That's all they are. It's people who hope to be right so that they can be invited back on TV and say, I got the call right. Do they ever get the same call right 2 years in a row? No. So don't let 2024 predictions frighten you into buying or selling investments or making any changes to your financial plan, because it's all for fun. If you find that sort of thing interesting, I know I do, then it's for fun. If you don't find it interesting, then ignore it, because I promise you, it has nothing to do with your plans and your investments and what's going to happen for you. We have no idea what the market's going to do next year, but we know what we can control. If you need money for financial obligations in the next year or two, you know that set of money, that portion of money, should not be in the stock market. You know that if you're a certain age and you could have another 20, 30 years or more in retirement and you're worried about longevity, then that's a reason to talk about having more money in the stock market. But it's different for everybody. And by the way, if you want, reach out, check me out at clientfirststrategy.com. And we could take this conversation to a one-on-one, and we could talk about your investments and your plans and see if you're on the right track or not, and see if there's anything that you could possibly do to improve your finances going forward, either to make your money last longer in retirement or to maximize what your dollars are, potentially maximize what your dollars are heading into retirement. So you can check me out and we can have a one-on-one conversation about that and see if we're a good fit. I'm a financial advisor for over 30 years. And you know what's crazy? In about a week is the 18-year anniversary of Client First Strategy. 18 years. I cannot believe how fast it went by. In any event, let's take a look at salesforce.com. Aftermarket trading. Stock is soaring. It's up just about $20 a share. We'll see if that holds for tomorrow, but that's a pretty good indication that when we've seen earnings coming out of the tech sector, they've been really good. And people keep saying that tech is too much weight in the major averages, in particular the NASDAQ and the S&P. Well, it's always been a high weight in the NASDAQ, but in particular the S&P 500. But it is broadening out the S&P 500 to other tech stocks and to other sectors. And if you haven't noticed, regional bank stocks have been doing very well. And there's other sectors that are starting to play a little catch up. So I'll end this by saying what I said yesterday. I see a lot of power in this rally. You see falling inflation, corporate earnings holding up pretty good, and in some cases going higher. Earnings surprises are being rewarded with large gains in the stock price the following day. And you are seeing fund managers who've committed too much money to cash who now want to bring that money back into the market because they're now chasing performance. The major averages are up a lot this year. And if managers have been sitting in cash, now they're looking bad. They're behind their benchmark. Now they have to start plowing money like crazy into the market. And what are they going to buy? They're going to buy the stocks that are up the most because those are the stocks that can continue to go up the most. And in fact, their buying power, their catch-up buying, their chasing of performance is actually what's lifting those same stocks right now. At least it's a big part of it. So you should know what's going on, and that's about it. I will see you tomorrow. Always a pleasure. Have a very good night.